Hi, folks. Please read the disclaimer. Today, we're going to talk about the quickest way to make money in the market, or is there one? Let's find out. There's going to be a lot of data in this particular presentation, so just be very uh, attentive to the numbers that I'm going to mention. So, post-COVID returns from equities have been mind-boggling. You very well know that 240% returns in 63 months from COVID bottom till now on the Sensex. When we see mid caps, we've seen 440% from March 2022 to 40% was in Sensex, 520% in small caps from the COVID bottom. Of course, if we see from pre-COVID, it may be slightly less, but nevertheless, the numbers are still mind-boggling. So 26% CAGR in larger indices like Sensex, 37% in mid caps, and 41% in small caps since then. But we all very well know that CAGR is not the true indicator of returns. Rolling returns is. You are all now very extremely well-educated investors, and you don't really bother about CAGR. I know that. So if we see 1 year rolling returns across different market caps, starting in the last 5 years, starting March 21, year ending March 21, you will find that if you entered anywhere after March 2020 and stayed invested for at least 1 year, you would have gotten positive returns almost every time. So whether you invested in large cap, mid cap, small cap, uh, almost always you would have gotten a positive return. In small caps, if you invested anytime during this period, there was a 29% chance that you would have not made money in 1 year. This blue line that you can see, the rolling return goes into negative territory for some period, and right now also it is slightly in the negative. In mid caps, you find that this has happened only very recently and perhaps for momentarily in 22 also, so 7% chance only. And in a Sensex, a 5.5% chance of going negative, which is also in the current situation right now. So the 1 year rolling returns, you can see is that on the higher side, small caps returned even 130% in 1 year. On mid caps, it was nearly 92%. Oh, sorry, 100% by March 21. And on Sensex, it was nearly 68% uh, returns for that 1 year, the max 1 year. So easy way to quick money, one would think, but it is unfair to calculate rolling returns post COVID. Everything was moving up in that period. So what about pre-COVID data? So let's look at pre-COVID data. So we've got the data from April 2006, which is a good, 19 years of good data, 19 plus years. Here you can see that if you were to look at, let's say, the Sensex, about 20% of the times you would not have made money in a single year. If you had invested at various points, there was a 20% chance that you would not make money within 1 year. If it were the mid caps, there were about 25% chance that you would not have made money. And in small caps, it was about 39% of the times that you would not have made money in a single year. So, not every 1 year investment has been profitable. Of course, you all know that. And the extent of damage within 1 year has been as much as 71% on small caps, 53% in large caps, and 59% in mid caps. So the extent of damage is also deep, and the probability that you get a damage within 1 year is also quite deep. So there is no surety of returns if you invest for 1 year. What if we extend this study to 2 years now? So let's say we start at any point in the last uh, approximately 20 years, and see what are the returns for any 2 year period. So for any 2 year period, you see there is a dramatic shift. Now you find that only 16% chance that you'll lose money in Sensex. Uh, 23% of the times you're losing money in mid cap and 30% in small caps. And the extent also has reduced dramatically. Now, in any 2 year period, the worst fall is 30%. In any 2 year period, the worst fall in Sensex is only 18%, which is fantastic. I mean, the worst case scenario in the last 20 years for any 2 year period is only 18% in Sensex. So again, no short returns, but the extent of damage has been reduced dramatically. Let's take the study to 5 years. In 5 year time, the max loss that you had in small caps was about 8 or 9%. Any 5 year period in the last 20, you would not have lost more than 8 or 9% in small caps, even if you started at the peak of any small cap rally. In any 5 year period, you would not have lost more than 1.5% on large caps, or 3% on mid caps. So these are fantastic numbers. So within 5 years, you have reached a situation where pretty much significant double digit damage is out of the window. Assuming the last 20 years is a reasonable period of um, data that can continue forward, that big assumption is of course there, and the probability of negative returns has collapsed to 1.6%, 2.2%, and still double digits in small cap space, but the extent of damage has been controlled at 8% or 9%, and so on and so forth. So now perfectionists will say, what is that period where there is no loss at all? So let's try 10 years. 10 years, you find that there was no 10-year period rolling returns in the last 20 where large caps did not make money, mid caps did not make money. Small caps still had a one episode here where there was a negative return of 0.1% over a 10-year period. Otherwise, for large caps, you had a minimum of 5% return, and mid caps a minimum of 7.5% return over a 10-year period going forward. Uh, let's do one more check of 11 years, and you find that all are above ground in the last 20 years. Any 11-year rolling return period has given you decent gains. But what needs to be seen is that the average uh, rolling return that you can see is nicely above the double digit mark. And that is what one is looking for. So the long term aspect of the market, which I can continue to repeat in every episode, is not lost. I mean, that is the crux of the investing thesis for equities, that in the short term, 1 year, 2 year, 3 years, you may get very lucky and you may have fantastic gains, but there are enough probability cases in the past which says that within 1 to 3 years you may lose money as well, and it's only above 5 years that you start to really get towards zero negativity in terms of outcomes, and above 10 years and 11 years you really go to a fantastic outcome on that. So data is illustrating that 11 years and onwards, at least in the past 20 years, no negative performance has been achieved, and market essentially is not a get quick rich scheme. uh, so when you come in with the right expectation, come in with the right glide path. If you get lucky to start with, that is being very lucky, but sometimes that is not so good for you, in the sense that, let's say I wanted to bring in money over next 5 years, and I put a very small quantum of money in year 1, and then the market doubled in that year itself, and then did nothing for 6 years. Suppose that situation really ruins a lot of psychological expectation. I had to put in 10 lakhs, I put in only 1 lakh. Now that 1 lakh has gone to 2 lakhs, but then for the next 5 years, whatever money I've put in is not making any money. That really sucks the positivity out of investors. So when you're coming in, that itself, that expectation and that mind frame itself should be there, that there is no shortcut or short path to success, and that investing is going to be a marathon. You have to stick with your strategy and just continue to go along, and time is acting as your friend. Don't try to time it, and don't try to do shortcuts. Of course, there are other strategies, other time frames in the market where quick getting rich perhaps is possible, but the percentage of people getting that right uh, caliber or skill set is very very low. I mean, all the data that comes from the options and the FNO space that is there. The bonus chart here is that of gold. So while we were doing the studies, we thought let's also look at gold, what happens on a rolling return basis. And there we found that on a 8 year rolling return basis, we find that you always make money, at least from this particular data set, assuming that this data set is sacrosanct. So the insight from here is that it took even less than equity to stay positive, 8 years versus 11 years, and the consistency of returns is reasonably smoother than the equity curve that we've seen. Here again, I mean, on a very long term basis, you will get 11.7 or 12% as your mean returns on gold going in a long term basis. So that's why we call it the best hedge and a good partner to equity in your portfolio. So this is all about long term investing, all about staying the course. This jumping around from one strategy to the other or one asset class to the other, this has not helped anybody, and you have to play the long term game. Let us know in the comments what are your thoughts about this. I'll be looking forward to this, and do share uh, and like this video, and do subscribe to the channel as well. Thanks. Bye.